Hey guys, the purpose of this channel is to discuss with you every single week the stocks that I think are worth investing in. Just to mention straight away, I'm not a financial advisor. I just did my own research and analysis, and you should really do yours to find the shares that are suitable for you, for your purposes, that you like. It's always worth doing your own research before actually getting the shares. So, saying this, let's dive in. The share of this week is CVS Health. CVS stands for Consumer Value Store. It's an American company that owns multiple brands in the healthcare industry, such as CVS Pharmacy, a pharmacy provider, CVS Caremark, pharmacy benefits manager, and Aetna, which is the healthcare insurance company. As you can already see, the company is very well diversified among the different healthcare industries, different healthcare parts. So you can already see the benefit of it in terms of diversifying your portfolio as much as you can. You're just buying one company, but you're actually investing in different industries across the healthcare. The second reason to get the CVS Health, the company is extremely cheap given its value. On the Genuine Impact app, as you can see there, none of the rankings are actually in red, which is a very rare profile for any kind of company, especially such an established company in such an established industry as a healthcare. Also, for the past 4 months, the earnings of the company beat the analyst estimates, which is also a very good sign. Another advantage is a relatively recession-proof industry of healthcare. You probably already heard all this noise about recession and financial crisis coming in the past weeks and months. In the US, recession by the textbook definition is actually already there. That's the 2 consecutive quarters of the negative growth. In the UK, the Bank of England announced that it's expecting the longest ever recession since 1920s, which is about 100 years. That's passing 2008, passing the pandemics, and still gonna be the longest recession. So obviously a lot of people who are buying their stocks are now trying to prepare for this recession, and healthcare industry is a good industry to have in your portfolio as a relatively recession-proof industry. I'm saying relatively because every recession is different and we never know what can trigger it now and how bad the financial crisis is going to be, how bad the stock's going to fall, and which industries is going to affect the most. But if everything else fails, if people don't have money to do any entertainment or any other activities, which hopefully not going to happen, they would always invest some money to healthcare. So even if it falls, it's not going to fall as much as overall stock market. The third reason to get CVS Health, the stock's beta value is actually less than 1, is 0.67, which means the company share price is less affected by the macroeconomic factors as well as the overall market movements and politics. In my opinion, in the current economic climate, it's a big advantage, and I'm trying to look for the stocks with lower beta value just to make sure that everything that's happening in the world right now, all the changes are not impacting my share price as much. And last of all, I'm always looking at the other analysts' opinion about the stock, and on both Freetrade and Yahoo, the company's share price is in green as per analyst estimate. Even the lowest estimate is still in green. It's about plus 1.5 on Freetrade, which means even though the company is not performing as well as you'd expect, it will still be in green, hopefully, unless something huge changes in terms of the company, politics, management, etc. Next, I want to talk about some of the risks to do with the company. Obviously, it's really good to always weigh the bad and the good and to see which company shares is perfect for you. You always have to be mindful of everything that's happening, and you need to understand the disadvantages of a specific stock. The first risk associated with CVS Health is quite high level of debt. I just want to point out the debt to equity ratio is still lower than 1, it's 0.94. However, just because we are entering this recession time period, you might want to rethink in favor of the companies with lower levels of debt. Essentially, the companies with higher debt level tend to go bankrupt more often during the recession, just because this is how the bankruptcy happened. You basically don't have enough money to pay off all your debt. I recently bought the shares of the companies. Obviously, for me, it's not as big of an issue, and I think it's still going to perform quite well during the recession, but you still might want to reconsider this and have a think about your own strategy. Another risk factor is that profit margins actually decreased from last year, so it decreased from 2.7% to 1%. However, we need to remember that last year was still a pandemic year, and the healthcare industry companies went up, and up to the sky. There was a healthcare industry boom, so that's why the profit margins were so high. in general, the profit margins of 1% for healthcare industry is quite low. It seems like that's why the company is so cheap. But across the healthcare industry, the average profit margins is 1.22%. So it's a bit lower than the average. Overall, the company is the buy for me. Obviously, does have some risk factors such as low profit margins, relatively high level of debt. But I think because of this period that we are entering of the financial crisis, the company is bound to perform quite well within the next 3 to 5 years. So we are focusing on long-term investing here, and that's why I think it's a good company to invest in. But you don't forget to subscribe down below and follow for more.